The phrase housing bubble tends to stir memories of 2008, the Great Recession that changed the world. But here in 2025, the talk of a housing bubble is resurfacing, and many are asking, is it the same story all over again? What is different this time? And why should entrepreneurs, investors, and everyday people care? Understanding the nuances between the 2025 housing situation and the crash 15 years ago is critical. It is not just about real estate. It is about the health of the entire economy, the availability of credit, and the behavior of consumers and institutions. The first major difference lies in the cause of the crisis. In 2008, the crash was triggered by a toxic mix of subprime mortgages, exotic financial products, and widespread mispricing of risk. Banks were lending to borrowers who had little chance of repayment, packaging those risky loans into securities, and selling them worldwide. When homeowners began defaulting en masse, the whole system unraveled, leading to a credit freeze and economic collapse. It was a crisis born of reckless lending and a failure of regulatory oversight. Fast forward to 2025. The current housing bubble, or recession depending on who you ask, is driven less by bad lending practices and more by a combination of high inflation, rising interest rates, and shifting consumer demand. The Federal Reserve and other central banks have been aggressively raising rates to tame inflation. Higher mortgage rates have made borrowing more expensive, pricing many potential homebuyers out of the market. Unlike 2008, lending standards are tighter. Banks are more cautious. The problem is not that banks are giving mortgages to unqualified borrowers. It is that qualified borrowers find it much harder to afford homes. This key distinction matters because it changes how the housing market corrects. In 2008, the problem was too many defaults and too much debt. In 2025, the problem is too little demand because of affordability issues. Home prices are starting to fall, but defaults have not surged dramatically. The crisis is more a slowdown than a sudden crash. That means the pain will be drawn out and affect more segments of the economy over time. Another critical difference is in the role of investors. In 2008, investors fled the market as values collapsed, creating a vicious cycle. Today, institutional investors hold a significant portion of housing inventory. Some are buying single-family homes to rent out. Others are focused on multi-family units or commercial real estate. This investor presence adds both stability and risk. On one hand, institutional buyers can provide liquidity and cushion price declines. On the other hand, they can also accelerate price swings if they decide to exit the market quickly or if credit tightens. The rental market is also different. After the 2008 crash, many homeowners became renters by necessity. Today, rents have risen sharply due to supply shortages and increased demand. The pressure on renters is intense, making affordability a crisis on both ownership and rental fronts. This has created new social and economic stresses, which could influence policy responses and market behavior going forward. Speaking of policy, government response is a major differentiator. In 2008, emergency measures such as the Troubled Asset Relief Program, TARP, zero interest rate policies, and quantitative easing flooded the market with liquidity. These moves stabilized banks but also prolonged the recovery. In 2025, policymakers are in a tougher spot. Inflation is more persistent, and interest rates are already higher. There is less room to maneuver. Stimulus packages or bailouts are less likely, meaning the market may have to correct with less government support. This reality forces entrepreneurs and investors to rethink risk management. Leverage is dangerous in an environment where borrowing costs remain high. Businesses that rely on easy credit may face sudden shocks if lenders pull back. That also means cash flow and liquidity become more valuable than ever. Those who hold strong balance sheets and maintain flexibility will be better positioned to weather uncertainty. Another key aspect is consumer behavior. In 2008, optimism and speculation drove much of the bubble. Many bought homes with the expectation of quick profits. By 2025, the mood is more cautious, even fearful. Younger generations, burdened with student loans and stagnant wages, are skeptical about home ownership. They view buying a home less as an investment and more as a financial risk. This shift in mindset influences demand patterns and creates a fundamental change in market dynamics. Technology also plays a different role. Digital mortgage platforms, online real estate marketplaces, and virtual home tours have transformed how buyers and sellers interact. While these tools increase efficiency and access, they also speed up market movements. Information flows faster, meaning markets can react almost instantly to news about rates, inventory, or policy changes. This volatility adds another layer of complexity for anyone involved in real estate or related businesses. The geographic aspect matters as well. In 2008, the bubble burst unevenly across regions, but many places saw dramatic price drops. In 2025, the correction will be more patchy. Some urban centers with strong job markets and tech industries are holding steady or even growing. Other areas, particularly those dependent on industries affected by inflation or supply chain issues, are experiencing sharper declines. This unevenness means that a one-size-fits-all strategy is not enough. Entrepreneurs must also pay attention to related sectors. Construction, mortgage brokerage, home improvement, and furnishing are all impacted differently in this environment. For example, new construction slows due to higher borrowing costs and reduced demand. This creates a shortage in some markets, supporting prices. But it also means fewer jobs and less business for suppliers. Understanding these ripple effects is essential for positioning your business to survive or capitalize on change. So why does all this matter beyond real estate? Housing is a cornerstone of the economy. It influences consumer confidence, credit markets, government policy, and wealth distribution. When the housing market shifts, it can tip the balance of economic growth or contraction. In 2025, these dynamics are intertwined with broader challenges: rising energy costs, geopolitical tensions, and rapid technological change. The housing bubble is both a symptom and a cause of larger forces reshaping the global economy. If you are an entrepreneur, investor, or decision maker, you must view the housing market through this broader lens. Reacting solely to price movements without understanding credit conditions, consumer psychology, and policy limits is risky. Instead, consider the long-term trends. Are you prepared for tighter credit? Can your business model handle slower consumer spending? Do you have contingency plans if interest rates remain high? This moment calls for strategic thinking. For some, it may mean shifting focus to rental properties or affordable housing segments. For others, it might mean pivoting away from real estate altogether or exploring markets less tied to volatile housing cycles. Flexibility and resilience are not buzzwords, they are survival tools. A subtle yet crucial factor in the 2025 housing correction is the psychological fatigue in the market. After years of price volatility, pandemic-driven relocations, and economic uncertainty, many buyers and sellers are simply exhausted. This emotional weariness leads to indecision, slower transactions, and extended periods of market stagnation. It is not just about affordability or supply anymore. It is about trust in the future. When people stop believing that home ownership will reward them, they step back. That loss of momentum can freeze entire segments of the market and prolong recovery. Recognizing the emotional undercurrent in economic behavior helps entrepreneurs and investors make wiser, more empathetic decisions during volatile times. Here is a critical insight: while the 2008 crash was a sudden collapse followed by gradual recovery, the 2025 housing bubble correction is shaping up to be a slow burn with unpredictable twists. That means you need patience as well as agility. It means constant monitoring of market signals and readiness to adapt as conditions change. Remember, every crisis creates opportunity. Those who learn from history without repeating mistakes can build stronger, more sustainable businesses. The 2025 housing market is no exception. It matters deeply because it reflects the evolving challenges and possibilities of our time. Your awareness, preparation, and strategy today will determine whether you thrive or struggle in the coming years. If you want to explore practical strategies to navigate this housing correction, how to protect your investments, optimize cash flow, and identify growth areas in a cooling market, then the next video will guide you through a comprehensive playbook tailored for entrepreneurs in 2025. Understanding what is different is the first step. Knowing what to do next is where real power lies.